The Bank of Canada says inflation is coming down and it's worried about households' ability to repay their debt. Yeah, we know there are serious issues there, and we're going to get into it in this, but let's talk about what they're saying. So, Bank of Canada Macklem says inflation is coming down despite April's gain. Bank of Canada Governor Tiff Macklem suggested April's inflation increase, the first in 10 months, was an anomaly and said consumer prices would continue to come down, prompting markets to pair expectations for another hike. The central bank has been warning Canadians that rates could go higher. April's unexpected acceleration in inflation to 4.4% from 4.3% in March has some economists forecasting a hike later this year. In my opinion, I don't think they're going to hike rates again. You know, would I like to see them hiking rates again? Yeah. Do I think it's going to happen, though? Absolutely not. I think they are way too weak. And they're also looking at the fact that people are struggling massively, because you have to remember the economy is in much more debt. A lot of people say, wow, Luke, interest rates back in the 1970s, they got up near 20%. That's right, but debt to income ratios were way lower back then. They've quadrupled. So holding a rate at 4.5% is actually like the equivalent to like 18% that it was back then, because debt to income ratios have just absolutely skyrocketed. So you have to bear that in mind when you think about these rate hikes. I know it sounds like a lower number, but you have to remember the debt portion. Inflation has come down. It is coming down. We expect it will continue to come down, Macklem said when asked about the inflation figures published this week, adding that April inflation data came in stronger than expected. And I think when you look at the consumer sales, they're actually down, and you have to remember those aren't even adjusted for inflation. So that kind of shows you where the economy is heading and how the consumer is actually doing. They are beginning to cut back, and I think that is evident, and we are starting to see the early signs of that. And obviously, because the data is so far lagging, and especially with the GDP later, we're probably going to be in recession by the end of the year. The reality is those of us that are in tune with what's going on know that we're in a recession right now, likely heading into a depression later this year. And, it's just unfortunately the reality of what's happening here because of the massive amount of can kicking, the inflation of bubbles on top of bubbles that have just caused this economic crisis. And, when we talk about inflation as well, let's go to the trading economics chart that shows Canada's inflation and how it's come down. But let's bear in mind, why has this come down from 8% to 4%? I mean, we know this is phony, guys. We've talked about it many times. How on earth can you trust a CPI basket that they constantly manipulate, they constantly change things within it? How is that accurate at all to looking at past inflation data? It's just not accurate. I mean, it has some accuracy of the inflation basket that it is reporting on right now, but how can you compare that to like the inflation basket in 2010 when they weren't the same? That's the funny thing about it. And that's what's changed a lot since the 70s and the 80s, and why the ShadowStats is much more accurate when it comes to inflation is because this was a fixed basket. And yeah, this is the US. It doesn't really matter that it's the US though, because the US is one of the biggest global economies. Most economies like Canada are just tied at the hip to the US. So you can see that if we were talking about the 1980s based CPI, we would be talking about inflation nearly hitting 20% in 2022. So that is starkly contrasting with what the government is reporting, which is 4.3% that it's at right now. And last year it got to around 9%, I believe, at the peak of it. So, that's half. That is half what it actually is. So, and we know that, we're not stupid. We see the price hikes, we see the price rises. But what you've got to think on top of that is, forget their inflation numbers. What's really happening is real wages have absolutely collapsed. So if real wages have absolutely collapsed, people aren't going to be able to sustain their standard of living. The standard of living is gone down massively, and it takes a lag for people to realize that that's happening. I mean, most people don't even have a budget. They don't even know what they're spending each month. They don't even know, they might have several subscriptions that they're not even aware of. I mean, it's just insane that people don't even do like a basic budgeting of expenses versus what they're paid. It's just so simple to do, but a lot of people don't do it. So there's a lag effect. And because of the debt, also the fact that people have credit cards and they can go onto the credit lines for so long, and then they get ramped up, and then they're in even more trouble. So it takes a longer period of time to show the effects of the rate hikes, but they're beginning to happen because people are in insane amounts of debt. I mean, it's not just people. It's not just people who've bought homes. It's also people with credit card debt. Many of those will be renters as well. So rental sector will also, a lot of people will be in financial distress there as well. And it's just a recipe for disaster that's coming down the pipe right now. So you can see where interest rates are right now. Do I think they're going higher? No, I don't, unfortunately, think that they're going to go higher. I know a lot of people think that they will, but I don't think they will at this point. And I think the inflation, what we don't talk about is, why is that inflation coming down right now? And inflation is coming down right now because, like I said, the consumer is getting into distress, and we're beginning to see that happen. So, it's not a good thing for the actual economy. And here's a chart of credit market debt to disposable income. Unfortunately, it doesn't go back as far as the 1980s, but you can see here that it's more than doubled since back in 1992, which is the last reading that we could get. And we know it was significantly lower before then because there was a bubble that burst in the 1980s, in the late 80s. So, the debt to income ratio, if you look at the US, has quadrupled. It could be even more in Canada. So that the fact that there is that interest rate differential could not matter. And also, you're starting to see Forex markets change as well. Not so much trading based on the interest rate differential anymore, more trading on the economic risk that they're going to see, because, they're looking at all kinds of economic indicators. Canada's are starting to show warning signs, and that is leading them to kind of get hesitant about going long the Canadian dollar. I mean, the Canadian dollar should at least go to 76 cents, in my opinion, and retest the bottom of the recent lower to go lower. I mean, that's just basic technical analysis, but that was if it was actually had some strength. It just seems extremely weak, and I hope we do get up to 76 cents, but I don't know if we will. I really don't know. I think it's 50-50 at this point with everything that's happened. And if we have more data that comes out that just shows how weak the consumer is, that's not going to help things. So, the Bank of Canada is saying that they're pricing in like a 60% chance of another hike. But yeah, we'll see about that. And then also the Bank of Canada said it was increasingly worried about the ability of households to pay off their debt and is seeing signs of financial stress among home buyers. The share of indebted households behind on payments for at least 60 days has been increasing since mid-2022, but remains below pre-pandemic levels, the bank said. So it's increasing, and the trend will continue. While most households are proven resilient to the increase in debt servicing costs, early signs of financial stress are emerging, particularly among recent home buyers. And, one of the biggest things for financial stress that I've talked about time and time again on this channel is the fact that we have this negative amortization situation. We have so many loans on the bank's balance sheet, not the Bank of Canada, but the big five banks in Canada. And many of those loans, like at CIBC, RBC, those loans are increasing, like as in people aren't paying down the amount of debt they have. Their balance is actually increasing. And that just shows major distress to me for the person who's borrowed there, the fact that they can't afford to pay that loan down. And it's just going to be an absolute disaster. I mean, we've talked about it many times on this channel, but I just believe it's really important because that could be what the yield curve is warning us about, because it is such a colossal amount of mortgages that are doing this. It's up to 20-30% of the loan book for mortgages at some of these big banks. And these big banks are huge in Canada. They're not small fries. So anyway, if you've enjoyed this video, you might like that video there. You might also like that video there. I want to thank you so much for watching this video and being on this live stream with me. It's another pre-recorded live stream. I have to watch them. You guys know the drill. I'll see you